Hello, class. Now we're going to go into Chapter 8. Another very important part of doing business with customers is the receivables. And the first thing a company would need to do is decide if they are going to have receivables, which are amounts due from customers who are given either a credit card or some kind of agreement, an extension of credit that the company can use to increase their sales. So there's several advantages and disadvantages. So of course the advantage is it increases the sales for the company, but in doing so it does take on some risks, because when you extend credit to a person, of course you don't know what's going to come about in the future. Various different things. COVID, one of the biggest examples is that we never know when a pandemic is going to hit. And if I can remember right, the last time we had a pandemic was back in the 30s. So, and that caused a great deal amount of problems for business owners, both very small and large ones, because they could not collect from their customers because, of course, they weren't working. Others were going out of business. Businesses were going out of business. So when we have these things come about where the customer cannot pay, whether it's a single individual or a company, it has some impacts on the financial statements. So first, it does increase wage costs. And then the bad debt cost that is created when the people cannot pay. And then it also delays the receipts of cash coming into your company. If credit is extended, the company will have to hire people to evaluate whether each customer is creditworthy, track how much each customer owes, and follows up to collect the receivable from each customer. So that is a little bit more detail around increasing the wage costs. If you have an accounting department and you're paying bills and things like that, and you're not extending credit, then you don't need the additional cost of collecting cash, sending out invoices, making sure customers know what they have. There's also disputes that the customer has. So generally, if there is an extension of credit, then a company needs to hire either an accounts receivable person or increases the job for the bookkeeper doing, or whoever is doing the books. When it comes to bad debt expense, inevitably, as I've mentioned, customers will dispute and cause things to change. And if a product is not satisfactory, they'll dispute their invoice. Sometimes if it's done in the mail, then inventory could be lost, which is another bad debt because the customer refuses to pay. And then the delays of cash. We like cash in our bank account, of course, to pay our bills. If we don't get that money coming in from our customers, we're not able to pay our own bills. So the way that bad debt is recorded, and this is generally more for medium to large size companies, is they'll estimate and report the effects of uncollectible accounts. So the way this works is that the original sale occurs, and you're going to debit the accounts receivable, which is increasing the amount of benefit due to you because of the sale, and then you're going to credit your sales revenue. So here's the impact on your balance sheet. Your accounts receivable is increased and your sales revenue is increased. So now we come to the point where we've been doing business for years. We know that a certain percentage of our accounts receivable usually ends up in collection or bad debts or is written off. So now what we do is take a percentage of what is outstanding in total accounts receivable. So let's say at the end of January, this company needs to adjust its accounts receivable by the estimated amount of bad debt. Again, bad debt is usually based on what has happened in the past. They are familiar. The company is familiar with this. They know things change. They know customers have problems. They don't blame the customers. They just know stuff happens. So now what they're going to do is, using that estimate, they're going to record part of the accounts receivable for the month as bad debt. So on the balance sheet, we have the accounts receivable, and then we're going to have this allowance account for doubtful accounts, meaning it's not focused on any one customer. That gets into a lot more details, but this estimate is just based on total receivables for the most part. Companies can choose the way they do it. They can choose to actually look at every single account receivable, see how it's doing. It could be based on credit scores. On one of the reports for regulatory reporting, we have a probability of default based simply on their credit score. And history shows that a lot of people will default on their loan if their credit scores are 600 or less. So they will automatically consider some of that bad debt. But keep in mind, when you're doing your homework and your quiz and your test, that this is similar to depreciation. You're going to have your accounts receivable is going to remain the same until the allowance is realized. So the account receivable is always the same, and then you have your less account, which is your contra account allowance for doubtful accounts. Again, the normal balance for doubtful accounts is on the credit side, for a negative on the assets. Accounts receivable less your allowance for doubtful accounts gives you your net account receivable. Then on your income statement, you're actually recording the bad debt expense. You're not touching the customer accounts at all until those are actually written off. But on the income statement, you are adding the debt expense. So your debit for debt expense, your expenses are increasing, and your allowance for doubtful accounts is increasing. Again, because this is a contra account. When we're doing this, the credit is what's increasing that account. And then decreasing assets. So you've just seen the first step in the allowance method, which is to record the estimated amount at the end of a reporting period. Now we're going to see the final step in the allowance method, when a customer's account is actually written off. So what happens is the customer starts getting behind on their payments. They call in, they try and make arrangements. They can't fulfill those arrangements, so now their account is about to go into collections. And what happens when accounts go into collections is that these collection companies, many of them around probably the world, especially here in the U.S., these companies actually purchase doubtful accounts and accounts that are being written off, because they let the customers know this is an attempt to collect a debt, and anything you say can be used to collect this debt. You probably get that same thing every time that you are approached by a creditor. If you're behind on your payments, they have to make that statement that this is an attempt to collect a debt. And usually when they're saying that, it's a collection company who has bought these receivables from companies that will that don't want to put in the money to make the collection efforts themselves. So now the transaction is you're going to only impact the balance sheet. So you're debiting the allowance for the doubtful accounts, meaning you're taking part of the doubtful account and reducing it. And then you're going to credit accounts receivable, so you're reducing the amount that that person owes. So you're reducing the total amount on accounts receivable. Keep in mind, when we say reducing a contra account, it's the opposite. The normal balance is the opposite, and that's why I say decreasing is the debit here, because this is a contra account that decreases the accounts receivable. One more time. When a customer defaults and the company is going to recognize the default, they are going to debit the allowance for doubtful accounts, which is the amount of the customer account. That it could be the whole thing, it could be just a part of it. There could be various different transactions that may be on different, set up on different, maybe they might have a credit card, they might have a loan, they might have a promise to pay. So it just depends on the contracts that are being written off. So generally it's the whole thing, but you're going to debit the doubtful accounts and you're going to credit the account receivable for that customer, bringing it to zero, or however much they are writing off. Just depends on the details. So the allowance method follows a two-step process as we've just gone through. You make an end-of-period adjustment to record the estimated bad debts in the period that the credit sales occur. So at the end of the period, the company will take the whole amount of the accounts receivable. They're going to calculate the difference, because those are the transactions that have occurred in that month, the difference from the prior period. Then they are going to estimate the amount of doubtful accounts. And then they're going to write off the second part later on is when customers fail to pay their accounts. They're going to remove specific customer balances when they are known to be uncollectible. So at the end of the period, generally speaking, again, I always say generally speaking because there are always exceptions to accounting rules. And that is the percentage of doubtful accounts is usually the same percentage from period to period. They basically take their accounts receivable total, and let's say the allowance for doubtful accounts is 20%. They're going to make sure that the allowance for doubtful accounts is 20% of the total account receivables. So let's look at some transactions. So the adjustment for bad debts in step 1. Assume that VFC estimates $900 in bad debts at the end of the accounting period. So here we are doing a credit, a negative, to the allowance for doubtful accounts for $900. So your assets are decreasing. And then we are doing a bad debt expense. So your expenses are increasing, but your stockholders' equity is decreasing. So here, this is your journal entry. Bad debt expense increases $900 and your allowance for doubtful accounts increases $900. This is that contra account that we talked about. And that's what that X means when you see these notations. So in your T account, your accounts receivable is at $120,000. Your sales revenue is $120,000. And then your bad debt is going to be $900 and your allowance $900. So these are the sales that have gone on during the month. This is the amount that they're going to increase their doubtful accounts by. So on your balance sheet, you have $200,000 less your doubtful accounts is your net allowance, is your net receivable. And this is how it is termed: accounts receivable net of allowance, meaning your total accounts receivable less your doubtful accounts is your net of allowance. So that gives it 185. And then on your income statement, you have your bad debt expense down in the every other expenses. So VFC writes off an $800 receivable from Fast Fashions because the company could not pay its account. So the first thing is the accounts receivable for Fast Fashions is going to decrease $800. And the allowance for doubtful accounts is going to increase $800 because this is actually being recognized. So your allowance is decreased. That contra account is decreased by $800, and the total accounts receivable is decreased by $800. So your bad debt expense in the first part of the transaction goes up $900. Your allowance goes up $900. And then when something is written off, the allowance goes down $800 and the accounts receivable goes down $800. So the balance at the beginning was $200,000. The balance at the end is the $200,000 less the write-off of $199 for the accounts receivable. Then you have your allowance for doubtful accounts. The beginning balance was $14,100. You take off the estimate to give $15,000, and then there's part of it that's written off, so it comes to your ending balance of $14,200. Your bad debt expense at the end of the period stays the same at $900. So there's two acceptable methods for estimating this bad debt in any given period. So there's a percentage of credit sales method, and there's an aging of accounts receivable. So even though the first method is simply simpler to apply, companies are given a second method because this is more accurate, meaning this is based on probably the customers themselves. Like I mentioned, the impact of the FICO score, okay? So that's part of that aging of accounts receivable. The percentage of credit sales method estimates bad debt expense by multiplying the historical percentage of bad debt losses by the current period's credit sales. And I referred to this when we began the discussion, that companies understand that they will not collect everything that they have in accounts receivable. If a company exists where they have no bad debts, their allowance for doubtful accounts may be zero or very, very low. If a company is one that charges a high percentage interest rate, especially on their credit cards, they may increase their allowance for doubtful accounts because they are extending credit to people with lower credit scores and may have had issues with their credit before. So and this is why companies don't bark too much when they have to write something off, because usually in return they're making it up in the interest expense. So back to this problem. So this company has credit sales this month of $120,000. The bad debt loss rate is 0.75. So they're going to take 0.75 of that $120,000 and allocate it to bad debt expense. VFC has experienced bad debt losses of 0.75% credit sales in prior periods. Credit sales in January total $120,000. Kind of repeating what we just talked about and how they got to $900 in that original transaction we looked at. Again, the bad debt expense goes up and the allowance for doubtful accounts goes up. While the percentage of credit sales method focuses on estimating bad debt expense, which is an income statement approach for the period, the aging of accounts receivable method focuses on estimating the ending balance in the doubtful accounts, which is the balance sheet approach. The aging method gets its name because it's based on the age of each amount in accounts receivable at the end of a period. The older and more overdue an account receivable becomes, the less likely it is to be collectible. So the company applies the aging of accounts receivable method to its accounts receivable balances on February 28th, after taking into account February sales and cash collections. The method includes 3 steps. First, you prepare an aged list of accounts receivable. You estimate the bad debt loss percentages for each category, and then compute the total estimated bad debts. So a similar case when I talked about the probability of default when a company uses FICO scores. This is a probability of default using the number of days past due. So here we have 4 companies with their total AR and if they are current or not. So it appears that this company has different invoices that are outstanding at different times. They have one that's current and one that's 60 to 90 days past due. This momentum close is way overdue, over 90 days, and they've had no transactions since. Others have varied times, varied days unpaid. So of this 199,000, as we see here, it's just a accumulated amount of AR, different customers added together. Looks like most of them are on time, which is good. But we do have some that are slightly behind, some that are getting way behind, and then some that are very behind. And then Zoom Athletics, they've had some trouble in the last couple of months. So even though they have a new purchase of $4,000, they have another invoice or invoices totaling $2,000 that are between 31 and 60 days past due. So this is the first step. Generating these 4 categories are what companies usually use. And you'll usually see this on different regulatory reporting, different companies that report this to managers. They'll use the same time scheme. These 4 QuickBooks is set up to show this as well. So a lot of your accounting software is set up to show these 4 categories. So the next thing is you're going to estimate the bad debt loss percentages for each category. And these are, again, based on history. Companies, they may hire someone to do an analysis, they may do it themselves, but they'll come up with a percentage of, okay, when accounts hit 0 to 30 days, generally only 1% default. If the customers start getting behind, then when they get behind, about 10% end up failing. And then once they get over the 61 to 90 days, 20%. And then once they're over 90 days, then it's usually 40% of those customers have to be written off. So now what they're going to do is they're going to take a percentage of the total receivables. So on the 0 to 30 at 1%, you get $1,200. 45,000 times 10%, 4,500, and so on. Then your estimated uncollectible dollars is 15,500. All right. So this is your total AR. So this should be the amount of the total in doubtful accounts. Keep in mind, this is not the total that is going to be expensed yet. So we have come up with a new total for the end of the period, which is 15,500. At the end of the period, our balance in allowance for doubtful accounts is 14,200. We need to know what the adjustment is going to be. This adjustment is what's going to cause the expense, not the balance, the adjustment, because this is our desired ending balance based on $208,000 of receivables. Okay, so your adjustment is only going to be $1,300 because last month we reported $14,200. This month we want to report $15,500. for a change in the account of $1,300. So our allowance is going to increase the $1,300, and our bad debt expense is going to increase $1,300. Bad debt expense, it's the debit. The allowance is the credit. So here you'll see that when we add that $1,300, we're getting to our desired balance of $15,500. In the bad debt expense, we originally had the $900. We are adjusting it by the $1,300 to bring our doubtful accounts current to an ending balance of $2,200 on the bad debt expense. So sometimes we have to revise estimates. Bad debt estimates usually differ from amounts that are later written off. If these differences are material, companies are required to revise their bad debt expense estimates for the current period. And then sometimes we may have written off, a company may have written off a debt that later on the customer wants to clear up. Like I said in the beginning, most times those balances go to the collection agencies because they have purchased at whatever rate, whatever discount, the AR from the company. So it's generally them who can collect. However, some companies don't bother sending the amounts to collection. They just write it off and the expense stays there. They don't sell their receivables. They don't sell their doubtful accounts at all. So when that happens and the customer actually pays the company back, they have to reverse the entry for the collection that they wrote off. It'll make more sense when we get into it. So let's assume that VFC collects the $800 from Fast Fashions that was previously written off. And remember, this is a transaction we had a little bit ago where we wrote off this $800 because Fast Fashions just got too far behind. They decided just to write it off as uncollectible. They didn't sell it to a collection agency, so now they have to reverse their entry. So now what they have to do is first they're going to reverse the write-off. So the original write-off, remember, was debiting allowance for doubtful accounts and then crediting the accounts receivable. It was decreasing the Fast Fashions account receivable and increasing the doubtful accounts. So now we have to put the account receivable back onto the books, right? So now we have to debit the account receivable to put Fast Fashions back on the books, to put their $800 back in our balance sheet. And then we also have to credit the allowance for doubtful accounts. This actually is just a reversal of the original transaction to write it off. And then what we're going to do is increase our cash because we've received the $800, and then we're going to decrease our account receivable. Notice here that nothing is accounted for in the sales. When this comes to the company, it is not recorded again as sales because the sales have already been recognized when Fast Fashions originally bought whatever merchandise, whatever they bought, whatever services they purchased. That's when the sales incurred. That's when the company provided the materials or inventory, whatever services. That's when they provided. So that's when they recognized the income. When they're dealing with doubtful accounts, they are dealing with the bad debt expense, not the revenue. So the first step is to reverse the write-off, and then again post the cash and reduce the account receivable. Okay, before we move on to interest, I just want to just review just very briefly a couple of things. Number one, be sure you understand what statements are impacted they're going to help you with your journal entries. So when a company is just estimating their doubtful accounts, you're going to increase the doubtful accounts and increase your expenses. When a customer fails to pay their bill and the company decides to write it off, you're going to technically decrease the doubtful accounts and decrease the accounts receivable, because you've already recognized the expense. Okay. When a customer comes back and pays that account, you're not impacting revenue at all. You're not impacting the income statement at all when the customer pays for an item that has already been written off, or it was a doubtful account. So, number one, you're going to reverse the original entry. So look back on your homework, look back on your other transactions that would have happened, and simply just reverse it. Okay? You're going to be debiting accounts receivable and crediting the doubtful accounts. When you originally wrote off the debt, you would have debited the doubtful accounts and credited account receivable. So again, just flipping that transaction. And then you're going to account for the cash and then decrease the receivable again. Can you just work with the cash and the doubtful accounts? No. You have to do it in this way in order to recognize where the cash came from. Because when you just hit the cash account and your allowance for doubtful accounts, you are not recognizing that Fast Fashions is the one who paid on their accounts receivable. So don't take that shortcut. It won't be correct. Okay, so now we're going to move on to some interest and how it gets reported. So a company reports note receivable if it uses a promissory note to document its right to collect money from another party. So unlike accounts receivable, which are generally interest-free, notes receivable charge interest from the day they are created to the day they are due. I want to make just a quick note on the accounts receivable. Sometimes there are going to be fees on accounts receivable that have to be paid, and that is not going to be interest. There's going to be a separate account on your income statement that says perhaps late fees, other fees, something like that, but it will not be interest. It's really important to keep interest separate and only book interest when it truly is interest, when interest is calculated on an amount due. Okay? So unlike accounts receivable, as I said, they're generally interest-free. Duke Energy, your electric companies, your water companies, those are all accounts receivable, but they don't charge you interest on the services. Okay? That's the kind of transaction I'm talking about. And then on the notes receivable, those are a little bit different because the customer usually signs a different kind of contract. And the interest is specifically stated in the contract. And there's a specific maturity date or a specific payment agreement. So it could be over time. It could be that they've made this note on the first of the month. It's due and payable in 90 days. They don't have to make any payments, so the maturity date is the end of that third month. Okay, so to calculate interest, you're going to take the principal, which is the amount of the note, which is the amount of the loan, times the interest rate charged on the note, and then the time period for the interest collection. So that's why you have to know what the interest is charged. what period the interest will be charged. So if you are charged interest on a loan that has that is daily, that's very expensive. Monthly is your next least expensive. And then you have, usually companies go with an annual rate. So an annual rate is based on 12 months. Okay. So that's what it means by principal, the amount of the loan, the stated interest rate in the loan document, times the period for which interest is calculated. So here we have, for example, 3 notes, all at $100,000, all at 6%, matures in 2 years, 10 months, and 2 months. So the interest period is, this one is annually, because we see it's from January to December. So this is a 2-year note, and it's calculated annually. This one here is only for the 10 months outstanding, so it is January through October. And then this one, again, is just for the time that it's outstanding. So here we have the principal, the amount of the loan, the stated interest rate in the terms, and then the time. So 12 we have 100,000 times 6% times 1 equals 6,000. This will be the interest for the year. The 100,000 times 6% times 10 over 12, that's 10 months out of 12, the interest is 5,000. And this one, there's only 2 months of interest, so the interest is 1,000. There's 4 key events that occur with any note. So first, the note is created. The note is created when there's an exchange. The customer gets the product or services, and the company gets the document with the agreement. Okay, so that's on November 1st. So then we have the year end. So there are 2 months of interest. Notice this is from November 1st to December 31st. So we have 2 months of interest. So we calculate the year end interest. And then going into the next year, we have interest payment received when the loan matures on October 31st. And then we also have a principal payment received on October 31st. So the date, the original date is November 1st, 2021, the annual interest rate, the amount of the note, we have a maturity date of the note, and then the year end of the company. So assume that on November 1st, 2021, VFC lent $100,000 to a company by creating a note that required VFC 6% interest and the $100,000 principal on October 31st. So here, our cash is going to decrease because we're lending the note to our customer. We're lending $100,000 for equipment that they're purchasing. So on our records, we're going to record a note receivable for $100,000, and cash goes out the door. So in our equation, we have the principal, the interest, and the time. And this is only for the first 2 months. Remember, interest is calculated on an annual period of time, generally speaking. So it's only being calculated on the month that the notes are outstanding. And this is based on a company closing their books on December 31st. So at that time, they need to recognize the 2 months of interest. So they're calculating the 100,000 times the rate times 2 over 12, which is 2 months out of 12 for the $1,000. Their interest receivable, again, this is going on an interest receivable account. It's increasing by $1,000, and then it's going on interest revenue on the income statement. Interest receivable goes up $1,000, interest revenue goes up $1,000. So then we want to record the interest received at maturity. Notice when the interest was recorded that nothing is done to the note receivable. Record the interest received at maturity on October 31st. Okay. So here we have the $1,000, which was already recorded in the revenue, plus we have an additional $5,000 because we only have 10 months out of 12 in the next year. Okay, so we have the 6,000 is the 100,000 times 6 times 1. And that should be the total interest on this loan. So when we collect the principal and we are collecting the interest, we're going to record a couple of things here. So we did not collect the $1,000 from 2021 because the loan did not mature until October 31st. Okay. When we say the loan is maturing, we're simply saying the loan date due. Okay. Cash is increased by $6,000 on October 31st. We're going to reduce our interest receivable because we have collected the $6,000. Then we're going to record the additional $5,000 in revenue. So that's where you get your balanced transaction. Your cash increases $6,000, your interest receivable decreases $1,000, and your interest revenue increases $5,000. So now we're going to record the principal amount of the note that is received, which is simply the cash is received for $100,000 and the note receivable is decreased by $100,000. Notice again that the interest is kept separate from the note receivable because in simple terms, this note receivable is just the interest wasn't accruing was not being booked every month. It was only being booked when necessary at the end of the fiscal year and at the end of the note when it's maturing. So here we go again with our turnover ratio. So similar to our accounts, our inventory turnover ratio, we also have receivables turnover ratio. So we sell and we collect. We sell more and collect more. And so this is a constant cycle of transactions that occur over time. Rather than evaluate the number of times accounts receivable turnover, some people find it easier to think in terms of the number of days to collect receivables, called days to collect. In other words, how many days will it take for me to collect on the items that I have sold here? It could be in the next month. It could be in 2 months. How long does it actually take for me to collect my receivables? So you're going to take your net sales revenue, okay, $500,000, divided by your average net receivables, which average in our case will be the average of the years. All right, so we have our beginning net receivables and our ending net receivables, which beginning net would be the ending of the previous year. All right, days to collect. So 365 days divided by your receivables turnover ratio, which is this 10 days, is 36.5 days. So the comparison to benchmarks is when companies who sell on account, they specify the length of credit period and any cash discounts for prompt payment. That goes back to our 2 over N30, where if they pay within a certain amount of time, they get that 2% discount. Otherwise, in 30 days, the whole amount is due. So that refers to that. By comparing the number of days to collect to the length of the credit period, you can gain a sense of whether customers are complying with the stated credit policy. Meaning, this is due in 30 days. They want to see how many people are actually keeping to that 30 days, if that's what their benchmark is, if that's what their credit terms usually are. So here we have 3 companies. We have net sales and our net receivables. And so our first rate is the receivables turnover calculation. So we have the 13.8 divided by the average of our 2 years to get 8.9 times. We take that 365 days divided by the 8.9 to get 41 days. So you can see here that if VFC has a 30-day credit terms, most people are not following that because it's taking 41 days to make those collections. Post has 12.6 times is its turnover calculation, and then the days to collect is 29. So if their credit terms are 30 days as well, then the customers are pretty much paying on time. And then Apple has their net sales and then their receivables. Their turnover calculation is 11.3. And what it means is their inventory is turning over on average 11.3 times in a year. So that's 32.3 days, which their customers are slightly late on their accounts. One way to speed up collections is to sell outstanding accounts receivable to another company called Factor. I mentioned this earlier in the discussion about other companies buying receivables. That's all they do is they buy receivables and they collect. When this happens, a number of times the receivables that they are buying are the ones that are in doubtful accounts, are the ones that are that the company is having trouble collecting from. Those are generally what is sold. However, if a company perhaps needs some cash, they need to free up some of this account receivable because they have a major capital expenditure that they want to look into. So they may just sell some receivables to another company, student loan companies, for example. They may sell a handful of their student loans. They could be deferred, they could be on time for whatever reason. They're going to sell those to another company who probably does the same thing. The other company takes the right of collection. The terms on the note do not change for the customer, okay? It's just that that other company may want to maybe they have the capacity. They want to keep their employees working. So they go ahead and they buy that. And then the ones selling it collect the cash and they may be using it for some other reason, for like capital, or they may be downsizing. They may need to, their company's not doing well. They want to free up some cash to keep their people working. So they sell some of their accounts receivable. So the reasons that accounts receivable are bought and sold are varied, okay? But it's called a factor. So the company receives cash for receivables it sells to the factor, minus a fee. Another way to avoid lengthy collection periods is to allow customers to pay for goods using PayPal or national credit cards. This not only speeds up the seller's cash collection, but also reduces losses from customers writing bad checks. Not a lot of people write checks anymore, but PayPal and credit card companies charge a fee for their services. So sometimes companies will not accept credit cards because of these fees. However, how many of you always have cash to pay for anything that you buy? I, for one, keep very little cash on hand. I use my debit card for everything. In fact, the fast food restaurants, they know my credit card by heart, especially McDonald's, especially when you have little ones. So these credit card companies have to make money too. So they don't charge the company's clients the fee. So you will not see, let's say I spend $10 at McDonald's. I'm not going to see the fee on my transaction because the Visa company charges McDonald's a fee for accepting their credit cards, which is usually about 2 to 3%. When you add up 2 to 3% on a huge amount of sales, that can be a pretty big item. So that's one of the reasons why prices have increased over the years, is because as companies started using and accepting credit cards and having to pay this extra 3% did cost the companies a little bit more. However, what it did for the company is increase their cash flow. Now that the Visa card and MasterCards and Discovers and your PayPals and your other types of credit cards, now that they've taken the risk of the account receivable, the company actually making the sale is actually collecting their cash. Not right at that moment, right now, I don't think that exists yet, but within a day or two, these deposits start coming in, and it's usually an aggregated deposit of several transactions. So we're going to talk about the direct write-off method, which is reporting bad debts right away. So the direct write-off method does not estimate bad debt at all. Instead, it reports sales when they occur and bad debt expense when it is discovered. This method, keep in mind, is not acceptable for GAAP. Why? Because it's not putting the expense with, it's not matching the expense with the sales. When we talk about the methods before, and we are accruing or estimating the bad debt expense, we are actually estimating on the sales for that period, which is acceptable for GAAP because we are matching those expenses with the sales that they have occurred on. When the direct write-off method occurs, then when the company says, okay, this person hasn't paid in 6 months, let's just write it off. So they actually are going to decrease their net income at the same time that they actually write off the debt. So the past sales occurred in period 1. Okay, so we have our net income of $2,000. The bad debt did not get written off until the following period. So that's the bad debt expense because the customer didn't pay. So the net sales, the net income actually for period 1 is overstated by this $1,000 according to GAAP. And this is exactly what we talked about. It violates the expense recognition principle, the matching principle, by recording bad debt expense in the period the customer's account is determined to be bad. A customer account is determined to be uncollectible and $1,000 of bad debt expense needs to be recorded. So it's simply the bad debt expense goes up and the accounts receivable goes down. It has nothing to do with the allowance for doubtful accounts. It's just you're going to impact the account receivable asset right away. Okay, so that will do it on the kinds of receivables and how we can collect for doubtful accounts and how we record for bad debt expense, as well as some interest transactions. Again, as always, let me know if you need help. Let me know if a lot of people have been having internet challenges lately. Let me know how I can help. Please feel free to text me, as you have my number in various emails. Thank you very much. Have a great day.